One that's not showing red at all, though, is Ford. Those shares are jumping after beating on the top and bottom lines. And joining us now, Ford CFO John Lawler and our very own Phil LeBeau. Phil.
John Lawler, thanks for joining us. We talked about Ford beating the street on the top and the bottom line in the fourth quarter, but I want to talk about your guidance for this year. Strong guidance, $10 to $12 billion adjusted EBIT expectation, free cash flow expected to be $6 to $7 billion. You know what the sentiment was out amongst the average investors, that the legacy automakers would struggle with these new UAW contracts, and that business, while it would continue, would not be as strong as we've seen over the last couple of years. What's your outlook when you look at the year?
I think you're seeing the broader picture of Ford, the strength we have. We have an incredible commercial business, which was up 20% this year. We expect it to grow again in 2024. Our ICE business, Ford Blue, is doing very well. It grew the last 2 years. Profits were up. And, you know, we at Ford have an incredible position because we can offer our consumers choice across all powertrains, ICE, HEVs, and electric vehicles. So we cover the broad spectrum of what consumers want. You know, last year, our EV sales were close to 300,000 units, up 20%. So, you know, we're really in a good position to take advantage of the marketplace.
Let's talk about your EV expectations, because you're cutting down your full pure electric vehicle production outside of Detroit, at your plant outside of Detroit, cutting it down starting April 1st as the market, the growth there has just not been as strong as many expected it to be. Do you think that's going to change even more once we get into the second quarter and the third quarter?
Well, we're adjusting based on where the consumer's at. What we're finding is that you move past the early adopters into the early majority. They're just accepting the vehicles at a slower pace. And that's why the flexibility we have and the choice we have is key. But it's not the same around the country, Phil. When you look at the West Coast, Washington, California, Oregon, EV mix is 30% of our F-Series sales. EV and HEV mix is 50% of our sales. So the adoption is going to be different around the country at different paces. And with our flexibility, we can meet the consumer where they're at.
John, thanks for being here with us on Overtime. Toyota, your competitor, said today it's going to invest $1.3 billion at its Kentucky facility focused on electrification. How are you thinking about the amount of electric investment you're going to continue to make from here, even as demand, as you just mentioned, continues to be regional and less than some had expected?
Well, we're going to adjust as appropriate based on the demand. But make no mistake, EVs are coming and EVs are part of the future. So we like where we're at. We've been out with our first generation of vehicles for a couple years now. We've learned a ton. We're working on our second generation of vehicles. We're putting in a good footprint, although it's smaller than what we had planned, appropriately so, given the demand. You know, we're in a good position, especially with the fact that we're moving into our second generation vehicles in the near future where they'll be profitable, and we expect that they'll be game changers because it's not just the EV technology, but it's the connected technology and the software and services that will come with those vehicles.
John, it's Morgan. It's great to have you on the show. The fact that you did have this big beat, 29 cents adjusted, so much better than the street had expected. I mean, the expectations coming into this report and given some of the disclosures you'd had ahead of time around the cost of labor with this UAW contract coming into effect. Walk me through how you came to this beat and what it means in terms of 2024 with that cost of labor distribution.
Right. So we've been very focused on efficiencies and driving cost reductions through our entire system. When you look at 2024, we have $2 billion of cost efficiencies, cost saves that we plan to bring down to the bottom line this year, basically offsetting the impact of the UAW in 2024, as well as offsetting the cost increases on the new products we're launching for new features and emissions requirements, et cetera. So we're really starting to see traction on that front in the cost efficiencies that we need to bring to the bottom line. And that's what you're seeing show up, you know, in the fourth quarter and what you're seeing us guide to next year.
Hey, John, one last question. Pricing, as you look at 2024, everybody expects it to cool off just a little bit from some of the record levels we saw last year. What's your expectation in terms of when someone goes into a dealership, what type of pricing changes might we see over, let's say, the next 6 months?
Yeah, so that's really important for us. What we're seeing is that prices will probably come down from planning purposes. We're saying 2 to 3%. The most important thing is affordability. We think affordability in 2024 is going to go back to pre-pandemic levels, and that is percent of disposable income to buy a vehicle per month. We think that's going to revert back to the pre-pandemic levels. So affordability is going to improve this year.